While the Straits Times Index chases record highs, the auditors are reaching for the red pen. When a household F&B name like Katrina Group reveals that its survival rests on a single letter of undertaking, you aren't looking at a bargain. You're looking at a total loss event in the making. Today is April 13, 2026, and we are auditing the massive gap between a 5,000-point headline index and the harsh credit reality facing our heartland businesses. Looking at the broad market digest for today, we are seeing a tale of two speeds. The headline index is flirting with the 5,000-point psychological ceiling, testing all-time highs that make for great news headlines. But underneath that surface, T-bill yields have collapsed to just 1.47%, and the smaller catalyst minnows are starting to drown in net liabilities. It is a market that rewards the cautious and punishes those running on hope. In our market snapshot, the STI level sits at 4,968.80. While that looks strong, the safety of lazy capital in T-bills has effectively evaporated with the 6-month yield dropping significantly. This creates a required alpha of 3.23% just to hit our minimum yield hurdle of 4.7%. For the retail investor, this means the hunt for risk premium is officially back on, but the floor for safety has not moved. Turning to the Katrina Group, we have a major yield trap alert. The metrics are stark. A current yield of 0% against our 4.7% hurdle, and a current liability excess of 18.4 million Singapore dollars. The share price has already tumbled over 20% in a single session, but the forensic verdict remains a fail. This is a business model that is currently consuming more capital than it produces, regardless of what the ticker price tells you. Our 5-layer forensic audit of Katrina reveals deep stress. EY issued a going concern warning on the 10th of April, noting that survival hinges entirely on a director's undertaking valid for only 15 months. With a negative price-to-book ratio and a balance sheet that is trapped behind a debt wall compared to peers like Kimley, the situation is fragile. Even a 10% drop in foot traffic could exhaust remaining liquidity, potentially leading to a total principal write-off for a retiree. The going concern decoy is one of the most dangerous traps in the market. A share price down 20% looks like an opportunity to the untrained eye, but when the lights are only staying on because of a personal letter, you are funding someone else's exit. Kimley sells chicken rice with a clean balance sheet, while Katrina sells the same at a deficit. Always remember that the cheapest stock in the room is often the most expensive mistake you will ever make. In contrast, let's look at Capital and Investment, which we rate as strategic neutral. They are executing an asset-light pivot, evidenced by the final close of their credit fund raising $320 million. These funds are destined for first mortgage loans for logistics and office assets in Sydney and Seoul. This move into credit management provides a fee income sanctuary for investors that does not rely on the uncertainty of direct property appreciation in a tightening market. This lender's pivot is a signal we cannot ignore. When a massive developer like CLI decides to become the banker, you have to pay attention to which side of the table they have chosen. They are no longer just selling property, they are selling capital access. This confirms that direct property appreciation is no longer seen as the safest bet in the room, making fee-based credit management a much more attractive sanctuary for long-term income seekers. Moving to the hospitality REIT sector, the outlook for the first quarter is turning positive. Hotel revenue per available room, or RevPAR, jumped 11% year-on-year in February, helping to offset a slower start to the year. For a 55-year-old approaching retirement, the strategy here is to use this revenue strength to filter for trusts with gearing below 35%. This ensures the extra cash actually trickles down to your distributions rather than just servicing debt. However, we must remember that RevPAR is not a dividend. A full hotel means nothing if the mortgage payment arrives at the bank before the distribution reaches your account. Revenue momentum without balance sheet discipline is just a nicer looking way to walk into a yield trap. With T-bills so low, the temptation to rotate into these names is high. But without a high interest coverage ratio, that revenue is just a mirage for the retail holder. This brings us to the T-bill trap, which I compare to the MRT door paradox. Everyone rushed into safe cash when yields were at 3.7%, but now the doors are closing and the yield has halved to 1.47%. This creates a forensic gap that forces people to get desperate. They start looking at names like Katrina just because they are cheap, but a low yield is just a headache, whereas a zero equity restructuring is a funeral. To hit our sanctuary target, the equation is simple but strict. With T-bills at 1.47%, you need 323 basis points of alpha to reach our 4.7% hurdle. I maintain a conservative floor of 3.2% plus a mandatory risk premium to ensure our sanctuary assets can withstand a return to long-term average rates. Standards do not lower just because the market takes a temporary dip. In my take for today, the record STI is a bit of a mirage. Don't be blinded by the 4,968 level. The big banks are carrying the index while the catalyst sector is flashing a going concern red. CLI is moving into senior secured credit in Sydney and Seoul because they are being defensive. They are becoming the lender because they know that bank credit is tightening globally, and we should follow that logic. Recalculating our risk, we need to be honest about our equations. If your REIT isn't yielding at least 4.7% with a clean balance sheet, you are taking on equity risk for T-bill returns. Managing your SRS and CPF SA requires looking for cheap value, not just cheap prices. Buying into a net liability name is like buying house brand items at the supermarket where the expiry date was actually yesterday. You are asking for trouble. The final question you have to ask is whether your portfolio is actually anchored in cash flow reality or if you are just riding a headline high. The higher the STI climbs, the harder our forensic audit must strike. We cannot afford to be complacent when the credit reality on the ground is starting to shift so rapidly. Are you holding a sanctuary that will weather the storm, or are you sitting on a yield trap waiting for the inevitable? The difference between a sanctuary and a yield trap is often decided in a single trading session, and the window for identifying these moves is already open. Protecting your principal means moving faster than the general market. I am Iggy, forensic investor ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. The red flags were always there. If you want to see the full red zone watchlist and identify high-risk setups before they become public knowledge, join Iggy's elite investors. For less than the cost of a kopi and kaya toast set at Raffles Place, you stop being the exit liquidity and start being the analyst. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a mass licensed financial advisor before committing funds.